Hi, everybody, and a very warm welcome from me. Thanks, darling. Wonderful. Um, and I think I'm going to start on cable because we're on NinjaTrader here. I've also got TradingView, but it's just one of those days when what the charts reveal really are exemplary lessons. They are lessons in many different things, lessons in using multiple timeframes, lessons in using the indicators, yet lessons from a VPA perspective, all sorts of things. And as I say, I'm on cable here. And just one thing before I want to drop down onto the 15-minute, but just before I do that, just up here on the 1 minute, just to give you an idea of a trap move, look at the volume on this candle here. I appreciate it's a 1 minute candle. Look at the spread on that candle. Look at the volume associated with it. Does that make sense to you? No, of course not. It's a trap move. It's a clear trap move. And you can imagine everyone jumping in on this one, getting caught, and then the market reverses. I appreciate it's only a minute, but those are the sorts of lessons that are encapsulated and captured by volume analysis, which you would otherwise be completely unaware of. And that's why it is so powerful in whatever time frame you're using it, whether you're an intraday scalper or whether you're a longer term trader or even a longer term investor. The principles are exactly the same. The time frames I've got here go from the 15-second here right the way down to the 15 minutes. So we're very much up the scalping end of the market. But as I say, the principles are identical. The one thing that you notice immediately about this workspace is that there is one indicator that stands out, and that's the yellow dashed line, and that is the volume point of control. And what it's telling you loud and clear is that across the time horizons, right the way through to the 15, we are currently trading in a congestion phase around the volume point of control in the various time frames. Remember that the slower the time frame, the greater the significance, and therefore the chart at the bottom right, the 15-minute, which I'll pop up full size, make it easier on the eye. The volume point of control here is going to carry more weight across this time frame from 15-second to 15-minute. And that is the nature of trading or investing. Whatever you're doing, whatever occurs in a slower time frame, whether it's from a volume point analysis perspective, whether it's from an indicator perspective, whatever it may be, that time frame, your slowest time frame in your time horizon, will carry the strongest weight in terms of how it impacts the faster charts. So for the time being, we know we are moving in a sideways price action around 125.45 odd, where the yellow dashed line, we have the heaviest concentration of volume here. Anna mentioned the word patience, and if you're going to be a congestion trader and trade out of and trade breakouts, you have to be patient because that is the nature of the beast. It's if you have the patience to go and seek out congestion phases, whatever they may be, whether you're on the faster time frames or the slower time frames, the question is not if the market will break, because any market has to break out from congestion at some point. It's a question of when. Now, you don't know when is going to be. You often don't know what the trigger may be. Sometimes you do and sometimes you don't. In this occasion, we did know what the trigger was. So it's a question of being patient and waiting. And the beauty of it is really described. I couldn't really, there are so many lessons in here, it's hard to know where to start, but this really couldn't describe things in any better way. First of all, from a congestion breakout perspective, if you are prepared to wait and be patient in whatever time frame, you set your levels, you've got a ceiling of resistance up here somewhere, and you've got a platform of support down here somewhere, which runs right the way through here. So that would be your channel that you would set up either using the accumulation distribution indicator, or you could draw them on manually. Those would be your triggers, if you like. So if the market breaks to the upside, you've got a trigger there. If the market breaks the downside, you've got a trigger. Once that price action starts to develop, it's then only a question of at what point you want to jump in. And that, of course, is down to how comfortable you are with the price action being removed from the congestion phase and the likelihood of any reversal. But the strength of trading from a congestion phase is twofold. First of all, you have very clearly defined levels for your stop loss. So in this case, as we're moving to the downside, you would ideally wish to set it here, provided it fulfills your money management rules. And I can't see any reason why it wouldn't, because this congestion phase is pretty narrow. It's roughly 15 pips, let's say. So a 15 pip stop loss on here, absolutely fine. Your stop loss is then very, very well protected with all this price action. So that's the first point. The second point is that the downside support that is now acting as resistance is also going to help you in case there's any minor pullbacks, which often there are, often the price retests, but provided the breakout has occurred on rising strong volume and widening spreads, then there shouldn't be an issue of any reversal. And if there is, it's only likely to be a weak one. And that again will be confirmed probably with falling volume, which just give you confidence to hold the position. So the price waterfall that develops from here is one that I really couldn't draw. I couldn't sketch it out any better on a schematic, to be perfectly honest, because it just describes that perfectly in two ways. First of all, in terms of the widening spreads, which is what you want to see. In other words, the trend here is accelerating, and it's accelerating because the arc is steepening the whole time by virtue of the fact of the spreads widening. And secondly, it's confirmed by just rising volume here. I appreciate we're coming into London and we're going to see rising volume anyway, but this is 6 o'clock, bear in mind. So this is an hour before Europe and 2 hours before London. And we are seeing volume rising quite dramatically in that move. So again, you put the two together and they just give you a classical example of a price waterfall, exactly how it should be delivered. What then happens is we get down to this candle here. Now, as I've said on many occasions, these little dots, by the way, are for the volatility indicator, which works on average true range. It is basically looking at the price action, looking backwards, and trying to give you a signal as to when the price action has moved outside the average true range. In other words, we've moved into an area where the price is at an extreme, if you like, in terms of the spread. The indicator triggers in real time, so as soon as that parameter has been met, you don't have to wait until the 15-minute candle has closed. You would see it instantly. And as I've said many times before, if you've got some decent profit in the bank, and you certainly would have done getting in early here, then that may well be an opportunity to close out, because what you don't want to sit through is what is often following of a volatility indicator trigger, which is either congestion, which we saw here, or indeed a full-blown reversal. Now, in this case, it just happened to be congestion. We saw a hammer coming in here, which might have confirmed to us that perhaps we are going to see a reversal. We then move sideways, and then we get a bearish engulfing. This engulfs that candle, and we know we're off to the downside. And it really doesn't matter at that point, because you can then jump back in. So all you've lost in closing out your position, or maybe closing part of your position out, is you haven't really lost very much. All you've lost are some pips in here maybe, and that's about it. So if you close the entire position, sit tight, wait to see what unfolds. If the market breaks the downside, which it did in this occasion, then you simply jump back in and off you go and join the trend again. And down we go to the downside, and you've really lost nothing. It's as simple as that. So you get a second bite of the cherry. And of course, if you overlay this candle on this one, this is a classic, Anna mentioned re-entries, and this is a classic re-entry type candle. If you overlay the two, you would have had a body like this with a whopping great wick to the upper side and a ton of volume underneath it as well. So it's clearly telling you that this market is not strong. It's going to be weak. It's probably going to go further. So if you didn't get in on the first part, then you should at least be looking at the second part as a re-entry here to jump back in. We move on down. On this occasion, we got another volatility, but we had no follow through whatsoever. Again, if you closed out, fine, okay, and the market continues on lower and you jump back in again, fine, nothing lost, no damage done. And then, of course, we get down to the VPOC. Now, I don't know where the VPOC was at that point. I don't know if it was at this level or it might have been at this higher level. I can't tell you. I can't remember, to be honest. But we are now down here, and then we get the reverse of what we had here, which was an up thrust. We get a down thrust candle, or a hammer, if you like, overlay one on the other, what have we got? We've got a socking great hammer with a little body here and a huge great wick. So we are expecting, at the very least, given the volume associated there, to see some sort of reversal take place, which is what we see. We then see this recovery. Is this recovery going to go very far? The short answer is no, for two reasons. First of all, because these three candles have all got bigger wicks to the upper body than they have to the lower body. In fact, they've hardly got anything to the lower body of note. So that's the first point. And the second point is that rally is occurring on falling volume. That is anomalous. It's VPA 101. If we have a rising market in falling volume, then clearly that market is not going to go very far. And it doesn't. And we reverse back. Where are we going to reverse back to? Well, we're not going to crash through the volume point of control, which is probably now firmly established at this level. We're going to sit tight and see what happens. Now what we're seeing is we are seeing decent volume. In fact, the highest volume of the session come in under this latest candle. So we are starting to see quite a strong recovery. We have got a wick to the upper body. So there is some selling coming in there, knocking it back. But nevertheless, we've got a ton of volume coming in under that candle. Nice widespread up candles. Anna said potential reversals. And then we're coming up to this low volume node. The volume point of control really does do several different jobs. First of all, if we're approaching the volume point of control itself as here, then if the price action is approaching it, we are expecting at the very least congestion. So if we are in a good position, then that may well be an opportunity, a trigger to close out that position and wait for the market to congest, because that is what we would expect to see at that point. The second aspect of the VPOC is in looking at the nodes, and where we have low volume nodes as here and low volume nodes as here, then as the price action approaches them, as indeed it is at the moment, it's kind of testing them at the moment, if the price action comes up to a low volume node, then in the same way that the price action has gone through there to the downside because there's no support there acting in terms of volume, then we would expect the same to occur here, where the price action moves up to a low volume node. Volume acts in the same way as price. We're very comfortable with the notion of price acting as support and resistance, where we get strong areas of price support, strong areas of price resistance. Well, volume works in the same way, because where you have very well defined and deep areas of volume, then those are areas where previously the price has been in congestion, and it is therefore littered with a lot of orders. Some will be pending orders, traders, investors looking to get out. Maybe they got in, now they're in a weak position, they want to get out. It will be littered with execution orders, with limit orders. All sorts of things will be going on there. So there will be a whole cluster of orders sitting in those regions waiting for the price to reapproach, and then all these trades will be executed either as buys and sells. So there is a lot going on there. So hence the reason that when the price returns to these levels, it will tend to congest, because volume is therefore acting in the same way as price does, either as support or as resistance, depending on which direction we're coming from. So the histogram on the right-hand side, it's not just a pretty graphical array of the volume, although it tells us that, of course, instantly and very clearly. But what it also reveals are where we've got high volume regions. For example, here we have much more dense volume. So if the price does manage to break through this low volume node here, as it's being attested now, once it gets into this level here between 70.75 up to 2600, that's going to be harder work, because you've got a lot more volume sitting in that area, which is going to act as resistance in any recovery. And of course, what we're looking for now is how the volume shapes up under this particular candle as the pair reverse. So really, one chart, as I said at the start, it really does encapsulate a lot of lessons, a lot of analysis, a lot of examples that we can draw. And then, of course, we go back to our multiple time frames. We're seeing a lot of volatility all over the place. We've got a volatility trigger on 10. We had one here on 5. This is on 15-second, which gives us a heads up onto the very fast time frames. This is on 1 minute. We had a volatility here. We had another volatility follow through, then into congestion. Now we're starting to break higher. And up onto 3 minute, we had volatility trigger there. Into congestion, we appear to be moving away from that as well. So there's a lot of volatility going on here. There will be a lot of trap moves. And the problem with volatility and the issue with volatility is always that emotional response. Because we sit here as traders, we want to be trading. We don't want to be sitting here doing an endless analysis and studying the charts and being theoretical about everything. We actually want to be in here making money. And the problem with volatility is when you get snap moves, fast moves, the likelihood is that it will trigger emotion and the fear of missing out, because you'll see something moving very quickly. You want to trade it, you jump in, and very rapidly you see a reversal and you get trapped into a weak position. It's something the market makers use all the time, whether it's from a technical perspective, whether it's from a fundamental perspective. It's something they do a great deal. I can assure you it is immensely profitable for them, and you can understand the reasons why. Just have a quick look at the 10-minute. We've got that volatility trigger there. There we go. Trying to rally the market. Well, interesting to see what the volume is. We've got a big, you probably can't see it there, but there's a big wick at the moment. We've got up here just under 80, coming back down to 68. Interesting to see how that candle closes and whether there's going to be any follow through from that thereafter. And of course, we'll be looking at other markets as well. So that's looking at the VPOC just on these 6 time frames. I just want to drop down and show you something else, which is one of the new indicators which I've got, which is the volume relative strength indicator. And again, it really demonstrates for you. I've got to put it up on 5-minute. Yeah, we're still on cable here. This is cable on 5-minute from this morning or early part. Yeah, similar sort of time frame. There we go. This is the volume relative strength indicator, which is one we've recently developed. It's not launched yet. It will be rolled out in the next few weeks along with the stock trading program. But I wanted to put it on a chart here in the Forex space, just to really demonstrate that not only does it work brilliantly on stocks, on futures, ETFs, whatever it is, it also works in precisely the same way on Forex. We're on a 5-minute chart here. This is the price waterfall that we saw this morning. Very strong. The volume relative strength indicator looks at relative volume, and from that interpretation, it then gives us a perspective on the pressure that is associated in any trend, whether to the upside or the downside, and it does that in several different ways. The first thing we look at is where my cursor is, which is the crossover point, if you will, of the fulcrum from bullish to bearish or bearish to bullish in this case. Secondly, we have the color changes where we see darker colors indicate strength, in other words, stronger bullish or stronger bearish. Weaker colors indicate a lessening of that strength. The third aspect of the indicator is very much to do with the height of these pressure bars. So the taller the pressure bar, the greater is the pressure that is being applied to that trend. And the beauty of the indicator is in how we analyze it, because there are so many common crossovers with the way we analyze volume. In volume, we're always looking at comparative. Here we are looking at comparative. In volume, we are always looking at how volume bars are rising or falling over a period of price action. Here we do the same thing. We're looking at whether those pressure bars are rising or falling. So the commonalities are very, very similar between how we apply volume price analysis and how we view the VRSI indicator. And you can see here, it is self-explanatory. We get the trend developing, we get pressure rising. These are pretty much, they're all solid color. We then get a weakening of that as we move into this phase here, but we only just managed to creep back over the fulcrum line into potentially bullish, and it's a tiny, tiny pressure bar. So it's really telling us loud and clear, this isn't going anywhere soon. We then immediately revert back to a dark bullish color again, telling us this is strongly bullish, and off we go to the downside. And as you can see, we get rising pressure bars, really confirming the strength of the trend, confirmed with color. And what's interesting here is that even though the pressure here is diminished slightly, and also by virtue of the fact that the color has migrated from the darker color into this lighter color, the salmon pink, there is really no diminishing of the strength, because the height of these hasn't fallen away dramatically. It's not like here, for example. So it's really telling us, don't get flicked out yet. We've got more to come, and indeed, we do get more to come. Then we start to see the reversal and we gradually meander down onto our fulcrum line. But what's interesting about the trend here, this bullish trend phase of price action, it describes not only the weakness of pressure that is being developed in the trend, but it also describes the trend itself. And by that I mean the angle of inclination here is very flat. It's not going up steeply, it's only meandering up. Yes, it's a bullish trend, I accept, but the angle of incline is very weak. It's only 15, 20 degrees maybe. And the same applies here. Where you get very tall bars, then you're going to see an angle of attack, an angle of incline or decline, very steep. And the steeper the trend is, then the taller will be the pressure bars, really just confirming the strength of trend for you from a volume perspective. And we're into meandering price action here. We're above and below, so we're flip-flopping backwards and forwards, really not going anywhere. And now what we've seen, as we saw on the price chart, from earlier on the 15-minute, you can see here we've now got a real injection of volume pressure here, and that volume pressure is rising. So it's really telling us that, yes, this is a strong trend. It's looking as though it's developing strongly, and we're in quite a strong uptrend by virtue of the fact that we've got rising pressure bars, and they're also of the darker color. So that is the volume relative strength indicator. And as I say, I really just wanted to show it to you today in the world of Forex, because to make the point that it works in all time frames and in all markets, whether it's spot Forex, whether we're on stocks, whether we're on commodities, whether we're on futures, whether we're on ETFs, it really makes no difference. And the other point about it is this, that very much like the trend monitor, which gives us the confidence to hold a trend. The big problem we all suffer as traders and investors is staying in a trend. Let's face it, it's the hardest thing to do. There really isn't anything else hard to do in trading or investing. That's the number one that causes us the biggest grief. Because if we can't stay in a trend and maximize profitability, then all we end up with in a bunch of 10 trades is 8 or 9 losers, or 8 small losers, 9 small losers, and maybe only a couple of small winners. So our trading account is always going backwards. It's not collapsing, but it's never going forwards. And what we have to try and do is maintain those small losses at 6 or 7, whatever it is. But those 2 or 3 winners have to be a decent size. Let's just get rid of that. They have to be a good size. In other words, we have to maximize those opportunities when they come along. And they don't come along very often, so we have to maximize them when they do. And that's the other reason that it was a secondary reason for developing the indicator, really supportive of our volume price analysis methodology, but also unwritten, if you like, to give us the confidence of these color changes and the size of these bars to hold in a position once we see the pullbacks developing, which you see in all trends. When those devastating pullbacks come along and we come out, we get out, and we think, and then we see the market continue, and we're left with trader regret. We've all done it. We've all been there. We all suffer it. I can assure you we still do. We manage it very well. We've been doing this for so long now. But that is the number one issue. So when you're using indicators like this, it is very much in conjunction with volume price analysis, which is why I've only got 3 workspaces above and 3 workspaces below. These workspaces below are identical, the same time frames, but the only difference is there I have volume. So we are looking at the VRSI indicator above, and we are looking at our traditional volume price analysis methodology below and interpreting it in the usual way. So I wanted to cover that very quickly. Now, very quickly, I appreciate we've gone over time a little bit. Let me just hop up onto the trading view for a moment and just pick out the right ones here. This is the other one that I just wanted to show you very briefly. This is the market strength indicator. We're all familiar with the currency strength indicator, and the market strength indicator is precisely that. It allows us to look at any market we choose. I'll run through these very quickly. I've got this on sectors. These are sector ETFs. These are on slow time frames. I've got the daily, the weekly, and the monthly, I think, here. Yep, there we go. So these are sectors, so we can look at sectors very quickly. We can look at things like, what are we on here? we are on, I've got the SPY, which is the gray, and then I've got various stocks on here, which I'm looking at. So I'm going to be looking at the relationship between these stocks. I've got AMD, I've got Intel, I've got Tesla, and I've got Broadcom against the SPY. So how are these stocks performing against the SPY? Always interesting to know. These are the things that you want to know. This is another workspace. And in fact, I've got the currency strength indicator here because I've got the dollar here, which you can see. This is on the daily, so we've got the dollar rising here. And the reason I've attached it here is I was doing this on a video. We've got the UUP, which is the ETF equivalent. So you can see the relationship there between the dollar on the UUP and the dollar on our CSI, which is very close, which is what you expect to see. Over on the right-hand side, I've got copper futures. Why have I got copper futures? Because I want to see the relationship between copper and the dollar. And I can see it straightforwardly here between what we have the future on the right-hand side, and over on the left-hand side, I've got the UUP, but I could equally use the currency strength indicator in the middle here. The next one I've got is commodities. And here I've got 4 commodities. I've got copper, I've got oil, I've got silver, and I've got gold. So again, it's looking at relationships. Are those commodities moving en masse? Are they not? Is one moving contra to another? How are they moving against the dollar? And of course, you could do this with softs. You could do anything you like. And I think this is the last one. This is on bonds. This is bonds against the primary index, the S&P 500. So I've got the ES future on here, the ES mini, and I've got the 2-year, the 5-year, and the 10-year note on here. And typically, you would expect to see bonds moving together en masse, and you would expect to see them moving against the index, the primary index, which is the S&P 500, the E-mini future, which is the green line. So you've got these 3 lines down here, which are our bonds. This line up here is our index. And what you're looking at here, very simply, is a seesaw of risk on and risk off. And that's really all this workspace is, because you've got risk on in terms of the index and you've got risk off in terms of bonds, because money is simply looking for risk. It's looking for higher risk, higher reward in terms of equity markets, or it's going to fly to bonds where it's going to be lower risk for lower returns. And typically you would expect to see them moving in opposition to one another as they are here. But from time to time, as you can see here, the two are moving together. I'm not going to go into the reasons why, but it is to do with interest rates, particularly at the moment, where we have a unique situation with double-digit inflation, not driven by hot economies, but driven by the requirement to reduce inflation through the blunt tools that the central banks have at their disposal. And as a result of that, then bonds will tend to be reissued very frequently, because as interest rates rise, you're holding a bond with a coupon at one interest rate, one coupon rate. As interest rises, then your bond is worth less because the market rate is higher than the one you're holding on your bond. So your bond value goes down. And the reissuing of bonds all the time is interrelated with how the bond markets move as well. But typically, what you would expect to see in a more stable, if that's the right word, traditional, let's call it that, traditional marketplace where inflation is very much being driven by a hot economy and too much money flow, and not through the reasons that are being applied at present, then typically this is the sort of relationship you would expect to see, where you have indices, equity markets rising, then bond prices are likely to be falling. And if equity markets are falling, then typically you would expect to see bond prices rising. I think that was the last one I had set up there. That was another one. This was just crude oil. Crude against, this is again on the market strength indicator on a 5-minute time frame, and 3 time horizons over here with volume price analysis, because we always use our indicators in conjunction with our volume price analysis methodology. So I'm just going to pause there for a moment, just see if Anna wants to add anything to that. I'm just going to click off for a moment. Apologies. I think there was, Anna said there was being off air for a long time. Apologies about that. And I think Anna said there was a slight reversal due to someone on the Fed. Yeah, was something on the Fed. But as these things occur, it wasn't necessarily on the calendar, something we always have to be aware of. And again, But all of that will be reflected through the prism of volume price analysis, and that is the power of volume, because it just picks up all this information. And if the reason for the reversal is positive, then it'll be supported with volume, and if it's a trap move, then it won't. It's as simple as that. Finally, just to wrap up here, this is where you'll find all the indicators, not the ones I mentioned in the past few minutes there of the VRSI and the MSI, but they will be coming along. And if you have the full package, if you're a customer with the full package, then you will get those free of charge, which is something we do for all our customers, irrespective. They're currently on TradingView and on Ninja. Once we roll out the stock program, which will be in the next few weeks, then they will be available on TradeStation in due course and MT45 as well in the fullness of time. So if you have those full packages, you'll get all these indicators free of charge. I have to say also that the full package prices will be going up. We haven't put our prices up for 11 years, but with these coming out and also tying into the program, then the full package prices will be going up. So if you want to invest now, it's not a bad time in the next 2 or 3 weeks. If you've been a customer of ours for any length of time and you've invested in one or more indicators and you want to upgrade, absolutely no problem. We give you a full credit. Whatever you've purchased from us in the past, you'll be on the system somewhere. If you want to upgrade to the full package, or you want to go up to an education program, or ultimately come across the stock program as well, you will get credit for whatever it is you have bought. This is where you'll find the Forex program over on Quantum Trading Education. It's been hugely successful. We have a lot of wonderful comments. We have a huge number of students on it now. And in the last, I think it was the last 2 years or so, we bolted in the funded program where you trade our money. Basically, it's as simple as that. You start at a level of what we call the evaluation stage, where you are basically evaluating yourself. You are trading our money, so there's no risk to you. It's a one-off ticket of entry. And the reason we bolted it on was really to give our students the opportunity to put that knowledge to the test, but in a low-risk way by using our money and not their money. And it's a key thing, because in addition to that, not only is it very low risk, no risk, in fact, for our students, it also means they get access to much, much larger funds than perhaps they would otherwise be able to, because we start at $5,000, $10,000, $15,000. You decide on the level you begin at. It's a one-off fee of entry, and then once you've paid it, that's it. You cannot lose any more. It's as simple as that. It's our money. Of course, there are money management rules in there, risk rules in there, which you have to abide by. But you work your way up on the ladder. Each level has a target. When you achieve that target, we give you a percentage kickback of the profits you make. That goes on up the ladder, and you start at 5, 10, or 15. If you started at 15, the next level we give you is 60,000. Multiply it by 4. And on it goes right the way up to $2 million, as it says there, with no risk to you. And you're constantly earning as well. So as you're on each account, on each level, you're earning. The evaluation stage is limited to just the 28 pairs, but as you move up to the next level, we give you access to indices and gold as well, so you can trade commodities and indices in that next level on the what we call the I've forgotten what it's called. What's it called? I can't remember. Terrible. On the oh, where are we? Portfolio manager level. There we go. So you can trade the S&P 500 indices here, 4 indices, in fact 5 indices, and gold. So that's on the next level up, and then you go all the way up. As I say, you are earning profit as you go up the channel. Finally, just Anna's site, annacooling.com. Here you will find all the books which are up on Amazon, either in a Kindle version here or in paperback. There's also some box sets there, so you can buy a box set and get all 2, 3, 4 books there in one package. Very economical way of doing it. And down below, you'll find all Anna's Facebook pages with the latest posts, videos up there, and over on the left-hand side, analysis and so on and so forth. And Twitter too. Huge following on Twitter, loads of stuff going on there. You'll find a huge number of followers, and we do receive she gets some wonderful comments and commentaries from people who are using VPA. It has changed their lives. It's changed the way they're trading and investing, and for which they are eternally grateful. And I have to say, it is extremely humbling to read those comments, and many of the public comments as well on the books, also up on Amazon. So there we are. Thank you so much indeed for coming along today. Hope you've enjoyed it. We will be back tomorrow evening UK time, 8 p.m. UK time. So enjoy the rest of the session, and we will see you again soon, and bye for now.